All right, let's get right into it. We're talking about a fundamental regime shift at the world's most powerful central bank. This isn't just some minor policy tweak. We're talking about a complete rupture in the American monetary order. And for investors, look, understanding this shift isn't optional anymore. It's about survival. For almost 40 years, this one number, 2%, has been the anchor of global finance. It's the bedrock assumption that's baked into your 401k, your mortgage, pretty much every financial model on the entire planet. But here's the brutal truth. That anchor has come loose. The era of the 2% inflation myth, it's over. And the man who's likely going to be presiding over its burial is Kevin Warsh. So picture this, a series of lightning-fast political moves in early 2026. A DOJ probe into the outgoing chair conveniently wraps up, clearing the runway for Warsh to take the helm of the Federal Reserve on May 15th. Now, this wouldn't just be a change in who's in charge. It would be a change in the entire philosophy of money. Okay, so to really get where we're going, we first have to understand the myth that's been guiding investors for decades. This is the old world playbook, and here's the scary part. Something like 90% of investors are still using it. For generations, this has been the central dogma, right? An independent Federal Reserve, totally laser-focused on keeping inflation at a nice, neat, tidy 2.0%. The idea was simple. You keep prices predictable and the economy will thrive. But what happens when the government's own finances make that beautiful, simple goal completely impossible? And that brings us to the real reason for this whole regime change. See, there's been a fiscal crisis brewing just under the surface for years, and it's finally reached a point where that old playbook isn't just inconvenient, it's fiscally catastrophic for the US government. Here it is. This is the number that changes everything. $35.4 trillion. The sheer scale of the US national debt has created a trap. Economists have a name for it. They call it the unpleasant arithmetic. And what it really means is that it effectively forces the central bank's hand. Just look at this comparison. Back in 1977, when debt was about 35% of the entire economy, a 7% interest rate was totally manageable. The interest cost was just 1.5% of GDP. No big deal. But fast forward to today, with debt at 120% of GDP, that same 7% interest rate would swallow nearly 10% of the entire economy in interest payments alone. That's not a budget line item anymore. That's a direct threat to national solvency. The Fed simply cannot raise rates aggressively without risking a default. And this slide right here, this brilliantly illustrates the why. It shows you the choice the Fed is now facing. If they stick to that hard 2% target, it means aggressive rate hikes that would bankrupt the Treasury. But if they shift to, say, a range-based target, or even better for the government, price-level targeting, they can let inflation run a lot hotter. This lets the government basically inflate away its debt, paying back its loans with cheaper and cheaper dollars. It's a stealth tax, and it is now the new path of least resistance. So, how does this new reality actually take shape? Well, it's through what people are starting to call the Warsh Doctrine. And this isn't just a new policy, it's a new, much closer relationship between the central bank and the government it's supposed to be independent from. Instead of targeting a 2% inflation rate every single year, Warsh's preferred framework, price level targeting, aims for an average price level over a long time. Think of it like this. Instead of trying to drive exactly 60 miles an hour every single second of a road trip, you're just trying to average 60 miles an hour for the whole trip. So if you get stuck in traffic for a bit, you're allowed to speed up later to make up for that lost time. It's a subtle change, but it's profound. It means if inflation was too low in the past, the Fed now has official permission to let it run hot for a while to catch up. And that is the intellectual cover they need to let inflation solve the Treasury's debt problem. And hey, don't just take my word for it. Warsh himself has been very explicitly critical of the old system. He argues that obsessively chasing a single, arbitrary number is just counterproductive, especially when the Fed can't even measure inflation that precisely. He's been laying the groundwork to dismantle this thing for years. So here's the crucial point. While Warsh sometimes uses hawkish, tough guy language, his actual voting record tells a very different story. An analysis of his time at the Fed back during the 2008 crisis shows he is 4 times more likely to favor creative liquidity, emergency interventions, cash injections, than he is to favor the kind of painful Volcker-style tightening that would be needed to defend a 2% target. He's a pragmatist. He will provide liquidity to solve a crisis, and right now, the Treasury's solvency is the crisis. This quote, this one is maybe the most revealing of all. It signals a complete reimagining of the Fed's role in the world. That wall that was supposed to exist between the central bank and the Treasury, it's coming down. This new accord means coordination. It means the Fed's balance sheet will be used to help the Treasury finance the national debt. It's a dynamic known as fiscal dominance. Okay, so what does this massive policy shift actually mean for you, for investors, and for all those assets in your portfolio that you've always been told are safe? This new reality creates an incredibly dangerous trap for anyone in fixed income. Let's just walk through it. First, the Fed signals it's going to tolerate higher inflation. So, what do rational investors do? They demand higher interest rates on long-term bonds to make up for the fact that their money is going to be worth less in the future. That's called the term premium. Then, as new bonds get issued at these higher rates, the market value of all the old existing bonds with those lower rates, it collapses. And look, this is not a theory. We've already seen a preview of this movie. In April of 2025, the U.S. 30-year Treasury bond, supposedly one of the safest assets on planet Earth, lost almost 10% of its value in just 2 days. That's duration risk, and it can create stock market-like losses in the part of your portfolio you count on for stability. So this new world has created this profound split, right? A great divergence in how different types of investors are preparing for what's coming next. And the difference between them is, well, it's stark. And this is what's so fascinating. On one side, you've got retail investors who are still operating with that old playbook. They see bad economic news and they think, oh, great, the Fed's going to cut rates and my stocks are going to go up. But on the other side, you have the institutional desks. They see the real risk, the loss of central bank independence. They're not buying the dip. They're hedging for a world where inflation is structurally higher because it has to be to serve the government's needs. So how are the pros actually positioning for this? Well, assets that protect against currency debasement, we're talking gold, commodities, they're shifting from the fringe of the portfolio right to its very core. We're seeing institutional price targets for gold now exceeding $5,500 an ounce. The logic underneath it all is that the Fed's priorities have completely flipped. In this new regime, maintaining liquidity for the Treasury market is job number one. Price stability, that's now a distant second. Which, of course, brings us to our final and maybe most provocative question. For decades, investors looked to the Federal Reserve as the ultimate backstop, the ultimate protector of stability. But as the 2% myth dies to save the state, we have to ask a question that was once completely unthinkable. In this new era, is the Fed itself now the biggest risk?